Welcome back to this channel for practice problems for actuarial exams. My name is Krzysztof Ostaszewski. You can find information about me at smarturl.it/Jedi. I direct the actuarial program at Illinois State University. You can find information about it at smarturl.it/actuary. If you would like to make a tax-deductible donation to support our students, please go to smarturl.it/help ISU Actuary. Here's a problem for today. At the beginning of the year, an investor buys a zero-coupon bond for $400 with a par value of $1,000 and 10 years until maturity. This investor's tax rate on interest income is 35% and on capital gains is 20%. During the year, while the investor holds the bond, the yield to maturity changes to 8%. Determine the investor's after-tax return on the bond if sold at the end of the year. Additionally, calculate how much tax the investor owes at the end of the year if the bond is not sold. I consider all yields to be annual in the solution. So the annual yield to maturity as of the date of purchase is the rate of return that makes $400 become $1,000 after 10 years. So that 1 plus that rate of return to the 10th times 400 is equal to 1,000. So that rate of return is 1,000 over 400 to the 1/10 minus 1, and that's approximately 9.5958%. This is the rate which is used for calculation of imputed interest income as prescribed by the Internal Revenue Code. So the expected value of the bond at the end of the first year is 400 times 1 plus that interest rate, 438.38, and this gives $38.38 of imputed interest income. The actual value of the bond is 1,000 times 1.08 to the negative 9th, or 500.25. Thus, the investor enjoys a capital gain of 61.87, the difference between the market price and that price that we calculated based on the yield to maturity at purchase. After-tax income is 38.38 times 1 minus the tax rate on interest, and plus 61.87 times 1 minus 0.2, or 74.44 in total. After-tax rate of return is therefore 74.44 over 400, or 18.61%. Now, if the bond is not sold, the investor only pays tax on the imputed interest, and the amount of taxes is 35% of 38.38, which is 13.43. So the answer choice is A. Please remember this is copyrighted material. The problem itself comes from the Casualty Actuarial Society examination, so it belongs as the Casualty Actuarial Society. The solution is mine. Good luck in your studies and good luck on the test.